All right, what's going on, everybody? It ain't Friday yet. We're coming into the last week for the futures contracts. If you guys are trading futures, pay particular attention to the broker that you use. Some brokers will auto roll it and it won't be an issue. You just come in and it's going to be on the new contract. Other brokers, you have to decide when to roll. And the way that always been taught to do it is to look at the one that has the most volume. But I was recently working on a project where I don't know if you guys know any of the like the API coding connections, but there's a data source called Data Bento that you can get market data from. And in this project, we were trying to code uh, the the app that's being built to recognize when it's time to do a contract change. And uh, open interest was the one that was used quite a bit more than the intraday volume. So Thinkorswim doesn't show open interest from this page. You'd have to go out and look at the stock chart or add it as a column in the watch list. But the contract with the most open interest would be the contract that you'd want to trade. So it really doesn't matter one way or the other. This is also going to cause a gap. And of course, that messes with a lot of people. I promise next week on Monday, we're going to come in and people are going to, who didn't show up today, are going to say, "What the heck happened? We got this big gap." Or, "I see price at a different level than you. Why is my chart off?" And they're going to think there's something wrong with their data or something. So on Thinkorswim, you're running a continuous contract. When we get the contract roll, we're going to be at a new level and it's going to show a gap from where we were to where we are Monday. And then within 2 days, that gap is going to disappear and it won't even be there anymore. It's just this really weird time frame when we go from one contract to the next. And a lot of your drawings aren't going to match. And of course, price will be mismatched with the gap. So by Wednesday of next week, things will look normal again. If you notice the active contracts at 65.40 and the next contract out is at 65.95, it's almost 60 points higher. So if we was to come in tomorrow, we would be 50 points higher and we'd have this big gap, right? So just be mindful. Thinkorswim is going to do it on Monday. I've seen TradingView do it on Friday before, which means this Friday you're likely to come in and find TradingView already rolled to the next contract because they're using open interest, and I don't know what Thinkorswim uses. I think Thinkorswim just uses the day, right? Like that Monday you come in, technically Sunday night. I think they just do it, by the date. Blah, 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 blah. It does get a little tricky if you're trading things like commodities because they have a different expiry and they don't go to the next one out. I don't know how many of you guys trade copper or gold or oil, but the next active contract is not what's traded. So if you go look at copper right now, we've got an October, November, and then December, and the active contract is December. It skipped right over October and November completely, which is just really weird, right? That's why I always say you better know what contract, you better know what you're trading. so that you understand these nuances and these little difficulties that show up. These products close at a different time of day too. It's all you need is to get into something 2 minutes before it closes and have it close at like 1 o'clock in the afternoon. So know your product, right? The event bar today has been really helpful, but mostly in the later part of the day, which is why we didn't have it marked earlier. Let me just take these lines off for a minute. Well, you know what? I'm gonna put them back. We'll just swap drawings. That way we don't have to put them on and off, on and off. This morning, when we opened, we were nowhere near the edges of this candle, right? We opened in here. So marking the edges of it wasn't going to do us any good. We had already broke the half, so that wasn't going to be very useful. There was no reason to keep any drawings on that and instead of focus on everything from Globex and then focus on the intraday. This is a falling wedge, by the way, and they generally break to the upside. So we're still looking for an upside move out of this falling wedge that we're getting. But we didn't have anything else to work with, so we was just working on the intraday. But once we reached that low, which was a really nice measured move right into that low, by the way, that was beautiful. Once we got there, wanted to put our lines on the event bar because that is the bar in control. And of course, we broke down and got a 111 and reversed and came back up. And 65.32 is the 1236. So we'll take it. So here's copper with different contracts. And you can see the volume and the open interest are on the active contract. And that makes sense. But there are trades and there are volume on the other contracts. So it'll be a mess. We'll come in next week. People will be confused. It happens every contract expiration. Let's take a look around out there. I don't have any requested topics. So I say we take a look around and see where this market is at. And if you guys have something that you want to go through or you got something you want to look at, we'll certainly do it. If not, I say let's take a look at what's going on and see if there's any signals for weakness or a short. So this is a homemade Mag 7 chart. Really, we don't need it anymore because they made an ETF now called Mags. And as far as I know, most people are using that at this point. We'll just let's just use this one. It doesn't have a name. So this Mags is an ETF of the Magnificent Seven. And it does a really good job, all things considered. So we don't really need that homemade ETF anymore. We could just use this, just turn it into a line. If you look at that, just drag it over here. And then we look at this, we want this one. They look really, really close to being the same, right? This one's actually got a little bit of weakness. It started to roll over. And this one, sure, it's down, but it's not lower than this pivot. which is from Thursday the 4th. And here's Thursday the 4th, and that's below it, right? So there's a little discrepancy, but looking at this Mag 7 ETF, everything is still strong. We still have trend, we still have momentum, and this isn't even giving a topping pattern, let alone a short signal. So we don't have any reason to believe that there's a short in the broader market. I wouldn't try to short this market with this being so strong, right? I mean, look at that. That's absolutely beautiful. Really tight range too. Now this is it's gotten a little wider up here at the top, but otherwise still looking really good. If you can't short the Mag 7, you can't short the broader market. That's just all there is to it. Then we've got growth versus value. It's kind of a really big deal. When you have a growth rotation, it's in control. So uh, that purple line here that I marked drama 2.2, it was this previous high. And then we pulled back and we broke out of it. It's still the one in control because it's where we lost this, right? So I've been keeping it marked. Actually, this one is where we lost this, but I've been keeping this marked since this last high, and that's why I kept it. That MACD or stochastics, that's my stochastics, topped out here, and we've been getting some divergence since then. So this is the drama level. If we break down below it, then we got the lower levels to work through. But it's still elevated. We keep coming back up. We got a higher high after setting these lower highs. And in this scenario, we don't want to try to short the market with this either. This is a IWF IWD ratio chart. And if you look at IWF, it's an ETF for the Russell. Don't ask me why that works for the Mag 7, but man, it does, and it does a really good job. So I always use this, but it is looking at the tree in the forest. So I also use this one. This is growth versus value also, but it's an S&P version. And in my opinion, it does a much better job of looking at the broader market's growth and the broader market's value and then measuring those two. This other one just does a really good job with the Mag 7. So, of course, that's the more important one. If you're looking for a short in a broader market, you got to have the Mag 7 going short if you're going to short it. But it's also good for playing stalls. If Apple, Tesla, Microsoft, Amazon, if they're all stalled against resistance, it's not a short, but it's not a long either, right? You could play like short call spreads, things like that. But this other one is a bigger picture of growth versus value. If we was looking for a flight to safety or a breakdown in the breadth model, that that chart's the better chart. So I look at them both, and if you look at the broader market's growth versus value, value is dominating. If you're unfamiliar with how to read a ratio chart, you've got two products. So we got SLYG and then we got SLYV. Since this name is first, if the chart is going up, that name is doing better. If the chart is going down, then that name is doing better. That's the easiest way to figure out how to read a ratio chart or to see who's outperforming, who's in control. So IWF, if this is pointed up, then IWF is in control. If it's pointed down, IWD is in control. The way ratio charts work. And we can see that value is dominating in the broader market. Staples and uh, A little bit of financials. Financials fit into that category. Healthcare, utilities. So a little bit of a discrepancy. This is a good way to measure Fed liquidity. When things get bad, say during COVID, liquidity really dries up in the market, and it's hard to gauge that. But it's not just times of economic stress either. It can happen in, say, if the market's starting to get worried about something in the bigger backdrop, um, rising unemployment, lowered wage, anything like that, rising interest rates, rising inflation, it can start to dry up liquidity. If companies can't get loans, especially short term loans and overnight loans, then the market really starts to suffer. The name of this is Bank of America US High Yield Index Options Adjusted Spread. That's a mouthful, right? But the ticker symbol, and just copy it and paste it here, is that right there. So if you're looking for it on TradingView, that's what you want to put in. And if you just start typing in high yield spread, it should pop up, right? You shouldn't have to type in that whole thing. When this is going down, liquidity is improving. And when it's going up, liquidity is starting to fall apart. The higher it gets, the harder it is to get liquidity. And of course, that makes the market suffer. So we want to see this trending down. And when it does pop up, because it's not a straight line like a drawing, it has to fluctuate like waves. When it does pop up, we don't want to see higher highs and higher lows. We want to see it hit previous rejection levels and continue to fade. And if you notice, it's grayed out below the daily. You can't look at it on an intraday. You only get daily, weekly, monthly, and it gets updated once a day. Sometimes it'll be behind by 2 or 3 days because of reporting purposes. So, like right now, it's still only showing the ninth yesterday. We're not looking at today's level. And that's important to understand if you're trying to go in and figure out, like, oh, wow, we just had big news today. What's up with liquidity? Well, this isn't going to help you because it's looking at yesterday's data. At the end of the day, depending on the platform you're using, it should update by 6 o'clock at night. But right now, we can see liquidity's fine. It did set this low at the end of August, and it's been kind of moving up, but it's still lower than this level. So until we get above that, I'm not too concerned. Back here, we got above that level. If we was to, like play the same scenario this way, we got above that level. It's a little cause for concern, but then we just dropped right back down again. Obviously, you don't need to stare at this one all day since it doesn't update, but I look at it every day just to see what's going on. This is the typical growth versus value ETF ratio pair that I like to use. Well, that everybody likes to use, really, not just me. RSP versus SPY. So it's the weighted versus the unweighted S&P. The reason that the Dow Jones and the S&P are so different is because of the weighting, right? So if you wanted to look at the S&P and get it unweighted, you could use the RSP. If you was wanting to match it like to the Dow, you could use the RSP. Otherwise, if you use SPY and the Dow are two entirely different kinds of indexes. They don't work well when you're trying to run them that way. But in this respect, when it's headed down, we want to see the market moving up. Because remember, the second word which is SPY here. If SPY is outperforming, then this indicator should be going down. If RSP is outperforming, then the indicator would be going up. The pink line is the S&P. I'm using the SPX here, but you could use SPY or take your pick. OEX if you want to use the S&P 100. But we've got this little like double bottom forming here, and we don't have anything like that up here. We're still breaking out and pointed up, and we did not get this sort of scoop pattern up here. The market started to readjust in a growth versus value, and the S&P didn't care. Now, the one thing that gets a little tricky with these is that both RSP and SPY can be going up, right? Just like this is often overlooked, but RSP is a market, right? It's the S&P. So there's your S&P equal weighted like the Dow would be done. And it can have an up day just like SPY can have an up day. And they can both be up at the same time because they're both the S&P. Well, if both of those are up, we're still trying to gauge, well, which one went up more? Which one outperformed? And that's why we can have this sort of maneuver where it pulled back, but the market really didn't dump down. The market pulled back a little bit, but not equal to that kind of pullback here. But we are at historic lows. If we was to zoom out and really put it on a higher time frame, depending on the charting platform, I heard some analysts say that basically where my yellow line is, that was as low as their charting had gone. They didn't have this back here. So I don't know if we should use that or not. What they were arguing is that their charting started after the 07-08 housing crisis using that 2009 low here. And if that's what we're using, then we're at, historic lows. But if we go back to say 2001, then we've still got room to go. Still, it is significant. That's a heck of a move. So we're still just really good here. If we were looking bearish or had a lot of weakness, this would be pointing to the upside. We would have the equal weighted S&P outperforming the unweighted. So this says the Mag 7 is still outperforming the broader market. And if the Mag 7's in control and outperforming, you can't get in front of that. It'll just run you over. So no short. Now, the more I learned about this one, I thought this is really cool, but tech is the Qs. So why would you want to use SPY when you could do the QQQ? This one's not as popular. And I think it's because the S&P is the one product that most places agree is their benchmark product, right? Because it always has been. And the old saying, if it ain't broke, don't fix it. And if you've ever tried to teach an old person something new, they'll say, I don't need to do that. What I've done has worked for as long as I've been doing it, and it still works, and I'm not changing it, right? So I think that the S&P is still used because, I mean, well, it does still work, and there's nothing wrong with it, and it's what we've always used, so why not just use that? But I argue that the Qs give a better outlook because tech really is the dominant play, right? To be fair, we've got tech in the S&P, so it does have the tech in it, but it also has financials, and it's just got a broader market representation. So I'm not disagreeing. I like this better. And this broke the previous low from August, and it's pointed even lower, but we're not breaking out and getting the high up here like we broke down and we're getting the low here. And I don't know what to make of this yet. I know it's divergence because it's a lack of follow through on the market side. It is divergence, but what do we do with it? You know, that's kind of the argument at this point. I don't know. But it's got my attention and it should have yours. If it gets worse, we're going to want to know it and keep track of it. Sorry, I can't type and talk, so I have to do one or the other. What I'm going to be looking for at this point is to see the ratio pull back or to see the cues break out. Let's see if I understand this question correctly. Here's the candle of control. It on the Nasdaq, it doesn't really line up the way the ES did, right? There was our 1, 2, 3, 6. So we would update the drawing to that level. We just got a new 1, 2, 3, 6 and an OCC. So we would update the drawing again to that level. And now this is our current 111 and our current 1, 2, 3, 6. So we're going to keep that. I'm not going to get rid of it, but we're going to swap over for a second. We want the Globex range, high to low, just to see what it has to offer. It's also showing us at 111 for the Globex range. Actually, I didn't get the right low on the Globex. There we go. So we got a 111 from Globex. We have a 111 from the event candle as the starting point of our measure. And we actually want to update that, put it on the intraday. Because once we left the event bar, we shouldn't be using the event bar. And we're at 111. And we're getting a doji, which is often what we get, right? Because 111 becomes a reversal. So now let's swap over to the ES. There's our 1, 2, 3, 6 as measured and projected earlier. And then we got the blue bar. So that's our OCC. We don't need the event bar anymore. So we're going to just put everything down on the intraday chart because it gave us our stopping point and this is our new level. If we break down from here, the next OCC is 6526. OCC stands for opposite candle color. You can see when we fell down here, we got this red bar that closed, and then we had an OCC, opposite candle color. I've had people say, why don't you just say we're going to go up or that it's going to go long or it's bullish? Because it's not that. We got another candle color. We paused momentarily. It doesn't mean we're going up from here. It doesn't mean we're going down from here, but we would pause. And a lot of times that's where I take profit and I close a trade because I don't know how much heat I'm going to get in the other direction. OCC, opposite candle color. So we got that. We update the drawings. And now if we get above 39, we're going to the half back at 48. But if we break back below the 32 cog, then we're going to 25. Level by level, round by round, just keep moving it as we go. The bias today was that we would hold the line and that things wouldn't get too nasty. I believe I also said that we would stay between the S and R lines. Well, here's the ADR. 6502 is the low end of that. And going all the way down there wouldn't make us bearish. That would just be the sweep, right? The wave. Price just moves in a wave. And those lows don't make us bearish. And those highs don't make us bullish. Price is just traveling, right, along the sweep. So if we drop all the way down to here, which I don't see that at this point. No reason to think we're going to go that low. But if we did, it would just be part of this sweep. It's worth marking that pivot right there. But let's get the SNR now that we got the ADR. So this is the CPR central pivot range. I leave the lines turned off, so we go in and turn them on. There's the SNR lines. We made it to R2. Woohoo! I mentioned that, right? That actually, I think I only talked about R1 today, but a lot of times in the stream, I'll mention getting an R2 for an S1. We did reject R2. We came back inside of R1. At this point, the floor pivot is the target. To get there, we got to get inside the channel after we break this pivot low and then Globex low and then the channel top and then the floor pivot. Then the outside, then the 20 period. Well, that's not the 20, then the S1 and on down we go. Level by level by level. So do I think we're going to reverse here? Probably at some point, but I don't know if it's going to be there. We're getting some ticks, so that'll help stop us from falling lower. The weighted AD is on the way back up. That'll help us from falling too much lower. We are on the turning point of the pivot. So if we was going to turn, we would do it from this spot. The problem with this is this isn't a 3-bar reversal. It's not a 2-bar reversal, and it's ugly. If I was looking for a reversal, I would want a nice clean 2-bar like that one or like this one, and we don't have that. It doesn't have to be that. We can go up without a nice pattern, but if I was looking to trade it, I would want a nice pattern. We just got through the midpoint of this bar. If you were looking to go long, that's a trigger to go long. But I don't like those 2 bars the way that they look like that. I want to see bears trapped and struggling and puking their guts out and getting their heads ripped off. This is like one of those little yappy dogs peeing in the snow, and there's nothing. There's no there. I know, bad analogies, right? Bad analogies. The there are some really good reversal patterns that exist out there, and I try to lean on those as much as I can. If I don't have it, it doesn't mean that I won't trade, but I'll really reduce my position size. And if I'm already down on the day, I don't want that. Or, you know what I mean? Like that. If I'm up on the day, I'm more willing to take the risk with a sloppier reversal bar. But not if I'm down on the day. And it's worth going through, kind of building out what you would be wanting, like in a playbook. Let me see if I can find some examples of that. All right, here we go. Come on. You can do it. So, pretty common knowledge. I like to use Discords to develop my playbook, to keep research, all that kind of stuff. This is a Discord that I built a long time ago, and it's focused on things like drop base rally and turning points, pivot points, that sort of thing. So, drop base rally is a really old concept, goes to the heart of like supply and demand and liquidity zones, that sort of stuff. I don't really like that language, that old school kind of talk. There's a modern way to talk about reversals and liquidity. So I try to leave that sort of talk to others, but I we all talk about the same thing. We just use, different language to get there. To me, every time I've seen somebody try to talk about support and resistance through liquidity zones, it seems like they just confuse things way more than they help clear up anything. So I don't bring that language into it. But when we're talking about reversals, this drop base rally is one of the most popular to focus on. And if you tie specific candle patterns to it, it makes it even better. So that you can get really picky and say, well, I only want the highest quality setup. And if it's not that, then I don't want it. Sure, you're going to sit out a lot. We call it opportunity, right? You won't have occurrences. That's the word I'm looking for. You won't have as many occurrences, but you'll have more quality trades when you do get a trade. And of course, you won't win them all because every strategy has losing trades, but there'll be smaller losses, higher wins, higher conviction trades. So some of those are like the evening star reversal, morning star reversal, hanging man, hammer bar, harami, and doji. So um, with these drop base rallies, if you can tie it into something with a really nice reversal pattern, then you can start to figure out, well, how am I going to get into these? What's my entry trigger? What's my setup? What's my alert? And you can see them coming because they don't sneak up on you. They should happen at 111, 1236, halfbacks, yesterday's high, yesterday's low, Globex high, Globex low. If they line up at the right spot and they give you the right pattern, then you've got a high conviction trade. If it doesn't have the right pattern, you can put it on watch, look for another signal to get in. You can use the sweep wicks. There's a lot of other entries, but there's a 3 bar, really nice 3 bar right there. It's like an evening star reversal. And look at that leg down. Just an absolutely beautiful play. So if you find examples of what it is that you want to trade and you study it, you'll start to develop the idea of what your trade is supposed to look like. Those drawings that I post in the chat, the one with the candles popping up and all that, I'm going to just post it here again. They're stickers, right? And they're the one that I just made, or not just made, the one that I just posted here, I made this, right? It's not real price action. I just made it up out of thin air. And this one too. Why? Because I know what my trade looks like. It's mine. I trade that thing nearly every day. Can you describe what your trade looks like? Do you've got examples of what it's supposed to look like? If you was to draw it out candle by candle, could you do it? Probably, right? I'm not saying that I've got some magic skill. This is not unique, but if you can't, you got to kind of wonder what the hell are you trading if you don't know what your trade looks like. This is a discussion on proximal lines and distal lines so that if we do end up with those candles down at the bottom, like today, where we didn't get a nice 3-bar reversal, and instead it's just a collection of bars, you can draw out your drop base rally demand zones. I don't even want to call it that, but that's what it's called. Get your proximal line and your distal line. The distal line is always the farthest away. That never changes. That's not the one. But proximal can change. It can be the highest wick of all of those bars. It can be the highest uh, body close of those bars, which would be this green one. So it can be in different spots, right? So that was one. Here's another way of doing it at the lowest body part, and that would give you the narrowest zone. Low occurrence, high probability. And then, of course, like I mentioned, that green one can be marked. Now, one thing that's often overlooked is the fact that support and resistance are look back functions. And I don't think newer traders quite grasp that logic. We don't know what support is, we don't know what resistance is until we look back and we say, oh, hey, look, price was supported there. That was support. But until it happens, we don't know if it's support. It's potential support, potential resistance, but it's not support and it's not resistance until we look back afterwards. If you open up a Discord and you start building out a system, you can study so many concepts this way. I've got Discords for options, price action, trend days, range days, entire Discords just for a book. Really doesn't matter, right? Like you could do anything. I pay a lot of attention to swing highs and swing lows too. There's no such thing as a definitive support and resistance. That's the whole lie, right? We can look back and say price was supported there, but we have no idea if price will be supported the next time we go there. No idea. Never. And anything anything could potentially be support. Just like anything can potentially be a pivot point. Because think about what a pivot is. If you are playing basketball and you're running in one direction and then you turn and go the other direction, they say, "Hey, look, Joey pivoted. He turned." And so anywhere that price turned is a pivot. Anywhere that price turned is a pivot. So then the trick becomes which pivots have merit or value and which ones don't. Like these right here. Should we count that? I mean, is that a pivot? That was some of the most difficult stuff when I was learning about price action, is that question right there, because there's no good answer to that. You have to decide for yourself if you're going to define that as a pullback with enough merit to register as a pivot point. And the textbooks won't give you a good answer either. So if I was counting these with lower highs and lower lows and trying to define, where my pivots are at, what would we do with that? And what I finally came up with for myself is that I'm looking for a collection of candles that actually traveled somewhere and then left that behind. Like this, we've got solid candles that actually ran up there and then we turned. Or here, where we had candles that went up there and then we turned. But what I've got circled here is just a bunch of dojis, and then we fell out and started to fall again. And the wicks were the only thing that gave us some kind of higher low in that. To me, I wouldn't mark that as a pivot. But technically, I mean, technically it is because price did pivot there, but I wouldn't mark it. There is some language about old stuff, right? And not really in the S&P because we're at all-time highs. So let's go to IWM. This thing is inside of some old price action. So if we were looking at IWM, we need something older than that. GM, yeah, General Motors. I'm on a monthly chart, right? And this goes back 20 years, but we can go back farther than that. So this goes back to the 80s, right? It's 1985, 40 years of GM sideways. Is there any merit in marking out that high? Yes, absolutely. When price gets there, we would look for a reaction out of it. Would I call it resistance? No, but I would recognize it as a key level, and that's from 2022, January of 2022. So it's a couple of years old. But even if it was all the way back here, the dot-com bubble, when party like it's 1999, Y2K issues and all of that. If we got there, it'd be a level of interest. I wouldn't necessarily say that it's resistance because we don't know it's going to be resistance, potential resistance. So it doesn't matter how old it is if you're in equities. If you're in futures, one of the reasons that we think previous price action has a reaction to new price action is because of traders' positioning. But contracts expire on the ES or in the futures, not just the ES. I don't want to pick on the ES. Contracts expire here. That's what these green lines are. So if I'm looking at this and we're going to revisit a level that we haven't seen in 2 years and it has a pivot, does it have any value? I wouldn't look at it and say, oh, well, yeah, there's probably trader's remorse. Those guys don't even have those contracts anymore. They're gone. They're out of that position. I would still mark the level as a level of interest, but we wouldn't have the same bias because those guys can't still be in the trade. And if you're doing it on equities and you are looking at something like GM, be mindful of stock splits that may have happened along the way, right? We were looking at something all the way back to 1985. In those 40 years, there could have been stock splits to where the price wasn't this price back then, that it was something else. Google used to be a couple $1,000s per share. And if you wasn't trading back then when Google was a couple $1,000s a share, you would look at this and you couldn't even imagine Google being that much. Or Amazon. Amazon used to be a couple $1,000s a share too. So when it comes to laying out your analysis, I don't have a current chart on this computer. It's on the other one. You can mark out your monthlies and your quarterlies. So these yellow ones are the monthly. And these orange ones are the weekly. Of course, you can do that for equities, and you could get yearly. I know it might be a little weird, but you could put a yearly chart. Each candle would be 1 year's worth. If you were looking at GM from 1985, you'd probably want a yearly chart. That'd provide some good value. But you can mark out your monthly and your weekly so that you got an idea what to be expecting at a price. Right? We can see that was Friday's high. And when we got back to Friday's high, there was a response there. It's useful to know where they are because they become tradable opportunities. Same thing with yesterday's low. That was Friday's close, and we got down there and tagged it, which is pretty neat. Another real good one is the year-to-date anchored VWAP, or just anchored VWAP, not year-to-date. So Thinkorswim in the last 2 years actually put in a Thinkorswim anchored VWAP. For years, we've been using a homemade code, but now we've got one straight off of Thinkorswim. If you're doing equities, you can anchor this to earnings events, large gaps, drug trials, investor day conferences, things like that. If you're doing it on futures, you could do it to contract changes, which I haven't had any luck with at all, by the way. I tried that and it just, at least on the ES, did not give me anything good. Maybe it would work on the NASDAQ or crude or gold or something, but on the ES, contract changes were not helpful. But one thing that I always like to anchor it to is the year to date. So starting January, where we're at. And I show it every morning in the morning briefing on TrendSpider. It's the white line on the right side chart. I guess it's the blue line here. That's the year YTD, Y2D right there, year to date. It's that blue, kind of a cyan line. That anchored VWAP is a really good line in the sand for how's that stock doing, or index, ETF, whatever. How's this market doing? Is it above its anchored VWAP or not? And we get reciprocation. So generally, if we go X distance on one side and then we cross and we start going the other way, you can expect at least that distance on the other side. Reciprocation. It also becomes a target if we start moving in that direction. That's where we're expecting to go. And when we get there, we expect to have a little bit of a struggle before we finally get done with it. Even on SMH here, we got there and we paused for a few days before we finally got away from it. You can also anchor high volume spots, right? So if you're looking at a chart, like you bring up Google or whatever, you look at the daily chart and you find a high volume zone, you can anchor it from that date. Some of these are smart depending on what platform you use, like on TrendSpider. You can just tell it, hey, go find the highest volume spot and anchor to that, the last volume spot, and anchor there, and it'll do that, which is pretty cool. Otherwise, you have to go in and manually spot it. Like here's a high volume spot. We could anchor this to the April 9 capitulation when the president said that he was just kidding about the tariffs and he backed off and the bond vigilantes calmed down. So that's another really good one. If you want to know more about the anchored VWAP, there's a man named Brian Shannon. He didn't invent it, but he's the one that I've seen with the most background and research on it, and he propositioned, proposed to the other brokers to put it on their platforms because most brokers didn't have it on there, and he wanted it. So it's because of him that most brokers now do have it. And he's wrote a couple of books about the anchored VWAP. He's an informed source. I think he's got some videos too. Certainly, he's done interviews with Stock Charts TV, TD Ameritrade Network. I'm pretty sure he's been on Bloomberg. Yeah, that's another one. Anchored VWAP at the open. I use an anchored VWAP from midnight. That's my default go-to. Thinkorswim by default uses the 6 o'clock VWAP, and I don't like that. I like the midnight VWAP, so that's what I use. Um, but I'll show you by the middle of the day, a lot of times they're lined up anyways, and it's like it wouldn't even have mattered. So if we just put a regular VWAP on here, I'm gonna kind of just clean up some of this stuff. Turn these bands off. I do not like VWAP bands. All right, so the purple line is the 6 p.m. VWAP, and you can see how it shot up 6 o'clock. The market opened in the Globex, and that's where it was. Mine shot up at midnight, and that's where it was. But look, they're almost the same now, you know. But in the Globex, which is where I do the bulk of my trading, they're completely different. I'm interested to see where the open VWAP is at. So we're going to load an anchored VWAP for today. And we will, I could have swore they had it to where we could start it at 9:30. We might have to use mine and adjust it. So I don't think theirs is going to start at the right time. It didn't. It's worthless. We'll use mine. I think mine has intraday. Use the anchor. Yes. Anchor year, anchor month, anchor hour, midnight. No, 9:30. That should do it. We'll see if it starts where it's supposed to. Yeah, 9:30 open. And it's at the same spot too. I wonder if we should start it at 9:29. Does it really change all that much? You know what I mean? Just so it gets that last bar. Before the open. Nah, it still doesn't change anything. So it's an interesting question though. Like would it matter? And I think if you're trading between 9:30 and 10, it probably would. It, it probably would matter quite a bit if you're using the 6 p.m. or the midnight or the 9:30. That one at 9:30 did a good job with price. Hmm, that's pretty neat. So yeah, you can anchor high volume, big gaps, earnings, events. Uh, that would be a good one to do anchored VWAP with too. Event bars on a day like this, instead of starting it at 9:30, start it at 8:30 when you got all that volume, because that volume has controlled price all day today. I would bet that volume in the VWAP would probably look pretty interesting too. So if you're trading in equities, if you're swing trading, the anchored VWAP can be a real bit of insight, especially if you're dealing with a market that's changing from being bearish to bullish or from bullish to bearish. I think Tesla's trying to come back. Yeah, it's trying to come back. I've got a VWAP chart. Why I keep rebuilding it? All right, so what we're looking at here is monthly starts on Tesla going back to the start of the year. So the white one is the year to date anchored VWAP. And then we got February, March, April, May, blah, blah, blah. Obviously, I'm missing a couple. It stops in July. I don't have August and I don't have September. But I just keep this chart saved. Then when I want it, I bring it up. That's not what we want. Because we don't want to have to go in and build this chart every time we want to see it, right? That would just get annoying really fast. So now we've got, oh, I got two red ones. Well, that didn't help. I'm running out of colors to use. Some days, me and Thinkorswim just go round and round. All right, there's the anchored VWAP for August on Tesla. But you can see how it struggled with the VWAP from February before it finally got that crossover. And then it fell back down and it was testing that same VWAP from the other side. So here it was rejecting. Here's where we finally broke out, and then it was testing it. Old resistance becomes new support. And then it was hitting the year to date anchored VWAP, and it finally got a breakout with a big gap up afterwards. I've noticed that gap a lot when we finally do get through the VWAP. A lot of times it jumps it, right? And the analogy that I was taught for this, you'll see it with moving averages, VWAPs, that sort of stuff, is what they say is if price can't get there in the daytime, it'll break in after hours like a burglar. So it tried to get there through regular trading hours. That didn't work. And then it made a big after hours move, right? It broke in after hours. You'll see that a lot in um, Bollinger Bands, moving averages, VWAPs. If price can't, and pivot points, if price can't get through it in the regular trading hours, it'll jump it after hours. So we've got an island forming, and this might end up being a bearish island. Price was making its move, and then it gapped, and now it's been doing all this work up here. If it gaps again, and it opens down here, then this would be an island reversal. Right now, we don't know it's going to be an island reversal. It's just an island at this point. If we break out of the top and go even higher, then that's all it was, is just an island. Save my chart. Oh, we don't want to quit Discord. No, 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 no. That's better. Take out the trash. Maybe get rid of some of that lag. So trend lines are kind of a love hate. I see a lot of people struggle with them. There are some good blog posts out there. I can't think of one book though that was instrumental for me when it came to trend lines. If there was, I would mention it. But I do say, when I started trading, I had access to TrendSpider from like the beginning. And every time I doubted if I was drawing a good trend line, one of the things that I would do is I would come over here and I would tell this thing to draw a trend line, and I'd see if mine lined up with theirs. Now, this is messy, right? Like, there's no doubt about it. That's some messy stuff. And this is what is original. So we can swap that to quote standard, and we see it a little different. Or they got like a complex version, enhanced. That's the word they like to use. Enhanced, that's like everything they've got thrown at it. That's a lot of mess. Now, once it's on there, though, you can start turning off certain lines because they're just repetitious. You know, they're the same line again and again. Like all of these that are streaming from way back there, those could be turned off. But I would use this when I was newer. I'd put a trend line on, and then I would question if it was a valid trend line or a good trend line, and I would come and check it here. And what this ended up giving me was the confidence that you can draw whatever damn line you want, really, as long as you can prove that price is responding at that level, then you're good. If it helps, you can go in the past and mark out your trend lines, kind of get a feel for it, right? It's like an exercise to where you just go and you mark out trend lines. I used to spend hours doing that. The frustrating thing is you can go back on a chart and mark, 5 years worth of trend lines. Say on Tesla, we could be all the way back here marking trend lines, but this angled line isn't going to help me with anything that we're doing in Tesla. You know, like we're all the way over here. So I can have all kinds of work back here, but it's not going to give me anything other than experience in drawing trend lines. But that experience also gives you trust that you're doing it right. Was this a valid draw? Yeah, look, later on, price responded at that level. That was a valid drawing. So you can teach yourself that what you're doing is legit by just going in the past and seeing, if I did it this way, would it have worked? Yep. The confidence is really what I think people are lacking there. And then, of course, it's what are you drawing it on? The way I was taught to do trend lines was that if price is going down, you wouldn't draw lines on the bottom, you would draw lines on the top, because what you're looking for is, when is this changing? When did we get so strong that we were able to break that trend line to the upside and start doing something different? Lines on the bottom wouldn't do us any good because we're already going down. What's the point of drawing lines down there? Until or unless you're focused on something like a channel, then you need the lines on both sides. Say something like IWM here in this range. That would have been a good time to have lines on both sides. Or if it's too steep, then what's the point of the lines, right? So usually if it's really steep stuff like this, I don't use trend lines. I use a Linreg line, and it's just what time you start and what time you stop. Notice I didn't bring my mouse anywhere up here. I just kept it along the bottom. I started on this date, I ended on that date, the line did the rest. To me, that's more valuable than a support line or a resistance line or a trend line, because I'm looking for reciprocation and how far we went above and how far we went below. And if I did want to redraw it, then just right click on it, turn it into a channel, and then we get that. Um, I've never paid for it. I don't know what tier levels they have. Oh man, I would start with the standard at least, right? There's no reason to go for the upper end unless unless you read the standard and you're like, nah, that doesn't have what I'm looking for. Then go to the premium. The premium has 5-minute back test, 5-minute scanning, 1-minute charts. That's pretty good. 50 alerts, 10 trading bots, and 10 workstations. And the standard doesn't have that. But like, this is what I have, and I've never paid for it, right? I get it for free. So I'm not arguing that I only have the standard, because I've had this thing 6 years, 7 years, and I've never once paid for it. They continue to grow, right? That this is one platform that I've got to say, every year they've come out with new stuff. They've got AI built into it now, and it connects to the Discord, so you can get Discord alerts sent from TrendSpider. I've got a S&P bot that runs on my TrendSpider, and I get an email from them every night, and I get an email from them if my bot triggers, and it's like a S&P closing below the 20 or something really simple like that, right? It's not a complex alert. I built it way back in the day just to see how the bot posts into Discord, but other than that, I don't mess with it too much. What's really cool is when you set up your scans, it uses plain English. So you don't have to sit there and try to code everything out. You can just use regular words like price broke above yesterday's high. It understands that. And that's cool. I haven't used the AI much yet. It's called Sidekick. I haven't used it much, but it is there. And the Sidekick, you know, helping you analyze your charts that you're looking at, which is different than when you go to like Chat GPT or something. You don't know where it's getting its answers from. This is looking at the chart you have, and then it's giving you answers from that chart. And I like that. These guys have a lot of videos on YouTube too. And they also do free market analysis that they'll send you in an email like once a week. It's worth signing up for them. Watch them on Twitter. They'll post really good things like, say, Amazon breaking out. I don't know if they did, but I would bet they had a post about Amazon trying to break out. I would almost guarantee that they had one on their Twitter because that's the kind of stuff that they focus on. And you can do futures here. In the last 2 years, they brought futures in. Of course, you got to buy extra data for that, but it wasn't expensive because you're not getting like full book. You're just getting top of book. I think they changed the way that it was written. That's the old way. This is probably the new way. Huh. And it does link up with Spot Gamma too, so that you can import the Spot Gamma levels every day and you don't have to try to draw them out. I thought the 10-year was going to give us more today. I really did. We didn't get much out of it. We had the auction at 1 o'clock, which timed with this reversal here. But I mean that's it. We were already trending lower. I guess you could say the rate of change picked up to the downside after 1 o'clock once we got that auction because we were just doing nice, gentle sweeps. And then at 1 o'clock, we got the auction and it got steeper. The rate of change increased quite a bit after one. I gotta write something. It's gonna take me a second, but I'm here. If you guys want to chime in, I just gotta type something out. All right. That yellow line is a monthly level and we're hitting it. That's a first touch play. Remember when I was out here on the monthly, we marked out that's last month's high. Even if we wick under that today, I would expect that we don't get too low below that. Not if we're going to keep this structure that we've been in. And this isn't the high. We're not going to collapse and burn from here. Probably. See, like back here, we gapped up and we opened way up here. And that was the end. And then we had a nice run down. It's possible that we can have a nice run down without that big gap up like we had there. We didn't have a big gap up on that one. So it's possible that we could leg down from here, but I don't see it. Also, the leg down is getting shorter. So this one, I shouldn't have closed that. This is 3.38, and that's 2.2. That's 2.3. What did we miss here? 2.24, 2.32. So that's a little longer than that one. It doesn't look it, but it is. So we're looking for at least that or less. I wouldn't look for a bigger move there because they've been getting smaller mostly. Turn that off and then just drag that sucker over here. If that's our high, this would be our pullback level. 6411 cog line. I like it. And there's our monthly bounce. Last week I talked about having a dedicated chart for your work, and somebody asked about futures with this same topic. Yeah, absolutely. If you haven't noticed, I go through the same charts all the time in the futures. So having a dedicated chart doesn't have to only be for us swing traders. It can definitely be for the futures traders too. And you could trade futures as a swing trade. But this is my default chart for doing swing trades. It has everything I want all thrown in there, which is not how I like to do things, by the way. Individually, I look at each of these indicators on their own, but collectively, I keep these three charts because it has all of the tools that I want. I just don't like to look at it this way. It's too much noise, right? It's too much stuff going on. So on the weekly, it's got the Bollinger Bands, the moving averages that I like, and then this stochastics down here. Same thing with the daily, Bollinger, moving averages, stochastics. There's supposed to be a Keltner on here too, but if you put the Keltner and the Bollinger on at the same time, oh man, what a mess. It's just a nightmare. So I don't do it, but it's nice to have the Keltner on there too. And I use this for stock analysis a lot, just gauging when we get a breakout, is that breakout outside of the Bollingers? If it is, are we coming back in? Um, a lot of time the breakouts hit the Bollingers, and that's all we get, and it stalls there. I don't know if you guys have heard me talk about multicollinearity, but I actually came across that here at Stock Charts. This was the first charting software that I ever had when I started as a trader. They've got live TV 24 hours a day that goes into market breadth constantly. And they've also got this chart school. And then they've got a real robust public forum in the background. And those guys, some of them only sell their work, but a lot of them give their work away for free. They've been there for years and it's all ranked. So if you suck, you don't get a good rank. All your posts are down at the bottom. But if you're really good and you've been there for years, then your posts are ranked really high and they show up at the top. So people that are really accurate and post really good content, they're ranked high up on that list. And they've always got really good articles, trade ideas, trade alerts. So I like having a stock charts account, but I don't keep it all the time. I swap to different products. I keep one for a year, then I go to Investors Business Daily, then I go to Seeking Alpha, and then back to here. But these guys, if you was to Google multicollinearity, which I can never freaking spell. Hopefully that'll just give us the link. Chart School, multicollinearity. They had this really good article that they had wrote. It's right here that talks about don't get all of your data from one category. And you can have 10 different indicators that are all looking at the same category, right? Like say volume, OBS, volume profile, the list goes on. So if all of your indicators are only looking at volume, then you're missing out on indicators that should be looking at things like trend or momentum, and that you should pick indicators from different categories so that you have a well-rounded perspective of what's going on in the market. When you go to build your chart, you'll want to think of those different categories and ask, do I have every category covered? There's one that they don't cover here that I would recommend adding, and that's volatility. Even if you're not going to trade options, you really want to know what the volatility is of the product that you're trading. So with volatility indicators, if you want to list, Thinkorswim does list their indicators by group, just not in the indicator box. So here's the beacon, the beaker, not beacon. So if you open the beaker, it doesn't really show it this way. You can use the drop down and you can say, just give me volatility studies, right? So here's volatility studies right there. Or just give me momentum studies. Here's momentum right there. So you can do it that way. And then you can cover every group: trend, momentum, volume, volatility. Try to pick one indicator from each one of those groups. But I'll still argue you don't want all of them on the chart at the same time. Like I keep this one that it does have them all, but this isn't the one that I use to do my analysis. Instead, on another chart, I put a Bollinger Band on and I look. And then I put my moving averages on and then I look at that. And then you know what I mean? Like I just do them one at a time because this is a big, nasty mess. Trend, momentum, volume, and volatility. Here's the article that I was referencing, and they don't have volatility on this list, but I would argue that you should go ahead and put it on there, right? Because that's the missing piece. There's four pieces, and that one's not on here. And then, depending on who you've got, if you've got options data that you can put on there, like the dealer GEX levels, that would be another category that you could put on. But they don't have that here because that's kind of modern, and these are old school. Yep, those are the GEX levels. So it was it wasn't like I hadn't thought of that before, but it was good to have it written down and articulated to where they said, "Look, you want one from each category." And I was like, "Yeah, I do want that." But when I was new, I wasn't seeing it this clearly. I just knew that I didn't want a stochastics and a CCI and an RSI. I knew that. I just didn't know why I knew that, why it mattered. This article I thought did a really good job of explaining why you don't need three that are doing the same thing. And there's no better one. I know that's usually the question, like, okay, I've got eight of them here for momentum. What's the better one? Whichever one you read better, because they're all reading the same data and they're all going to present that data to you in a different way. There's not a better one, but there is one that your mind is going to understand better. Maybe you like the tricks. Maybe you like Williams. I don't think there is a best one or I personally use stochastics, but I'm biased. Stochastics was the first indicator that I really ever dug into. So I tend to favor that one. But RSI is real popular, and RSI is adjustable for intraday with the two RSI 2. So, everybody's got their own. Shop around and try them out, right? But don't make radical changes to a lot of your categories all at once. Once you get it built, use it for at least 6 days. And at the end of those 6 days, you're going to have a real informed opinion about what you don't like. I always focus on that because I've never had to ask anybody if I like something. If I don't like it, man, I know I don't like it. I don't need you to tell me I don't like it. So use it for 6 days. And if there's something you really don't like about the choices you made, you're going to know. And then you can just replace it. Maybe you had RSI and you're like, screw this RSI. I don't like it. Great. Pick another one. The Arun indicator, that thing is so noisy. I hate that thing. I know people who like it, but I do not like the Arun indicator. It's just way too much noise. It looks like a pirate chart where X marks the spot. The really good thing about all of these old indicators is that there's been a lot of research done over the years. And if you're going to be a trader, you have to get good at research. So um, when I was first getting into college, they didn't have my credentials and I couldn't get into the college library. My argument was, well, I can't get any of my schoolwork done because I don't have access to the library. Something's wrong with my credentials. They got to get it fixed, blah, blah, blah. And they were like, oh, just go to Google Scholar. It's good. I didn't even know there was a Google Scholar. You know what I mean? Like, what? What is this? But it's really good. And it's got stuff from the government, from Goldman Sachs, JP Morgan. This is peer reviewed research articles going back for decades on any topic you can imagine. And they have researched stocks, right? Like trading, it's a big deal all around the world. You kind of got to be careful about which link you click because it's not all free, but a lot of it is. And you can see, I mean, it's not the first time I've been here, right? So if we was to look at um, market on close orders and research on that. And then we all know that 0 day trading has affected things in the last 2 years. We could look at any article from the last 2 years. That way, we're not looking at stuff from 15 years ago, wasting our time. And now we got a list of research papers that we can dig into on that particular topic. Now, what I've noticed is if this is a link well, that you can click, right? This blue writing, I can click on that. But this is also a link. If you go to Google Scholar and you look at an article like this one and there's no link here, this one's probably not free. You're probably going to have to buy it. Or that one there, right? It doesn't have a link here. It's probably not free. So if there's no link, you can try, but you're probably going to hit a paywall that says you got to buy that. But if it has the link on the side, a lot of times that's a free article that you can download a PDF, a research paper, an article, something that you can access without buying anything. So, this is a really good way to get background and research on all sorts of stuff. Also, if the indicator has a known developer, then research that guy. Like, Gerald Appel or John Bollinger. Of course, Bollinger made the Bollinger Bands. Gerald Appel, I believe, is the MACD guy. That what you'll find is they have articles that they wrote, maybe even classes that they've done. They usually have YouTube videos that go into detail about their particular indicator and how they use it, why they even built it in the first place, and little tips and tricks and little things that you can do to use it better. And that's really helpful because then you're getting it from the horse's mouth, right? You're getting it from the person who created it. Let's see, where are we at? With that drive we had in Bitcoin today, I would have thought the market would do better. We're really getting a disconnect between Bitcoin and the broader market. Look at that 10-year go. Fall down and die, you dog. That was a really nice move on that 20, not 20, that monthly. That's last month's high. Good place to play Save a Ho. Right? We came down and hit that level, 65.23, and that's where we bounced today. Um, on TradingView and on Thinkorswim, you can put your daily moving averages on your intraday chart. That's a really good one to have too, especially if you're day trading. Because I know a lot of day traders don't go out to the daily, the weekly, the monthly every day and look at what moving averages are out there. But if we're going to hit one of those on the intraday, you really want to know, right? And of course, you can just go out and draw the lines every day, but that's a lot of work. And then we're just repeating ourselves again and again every day. We got to go and get it done, get it done. But if you chart it with the indicator and then you save your work, it's always there. Every day in the morning briefing, I show this chart, and I know that there's a lot of noise here because we got to put all this stuff on there all at once. But if you look, there's the 3-week exponential moving average, 3WEMA. It's the 3-week exponential. There's the 10-day. There's the 20-day. Right? There's the 10-week. So that it's always there. And we can see how price responded on the intraday to that 20-day moving average back here. It's how we get a better feel for what should I expect out of price when it gets to that level. We can see it. It's done it before. Let's look at that on a 1 minute. See what price did when it got down there. Not as good as I was hoping, but still not bad. My computer just rebooted. That was weird. Timely though, I got that new one coming, so this one gets to go to the shop. I run 2 computers with 1 mouse, 1 keyboard. That way I can spread the workload between the 2 computers and they don't get bogged down. One more day. Wait. Did I pass it? That that 20-day bounce isn't showing on the tick chart. Or I'm not going back far enough. It's 5 days, it should be there. But still, even without that bounce, I mean, look how price is responding to that green line. That's my 20 period. We got down there and just kind of hovered around it, putting in a lot of work on it before it finally started to get away from it. And then the 10-day here, I get it. It's not a perfect touch, but that's an unrealistic expectation, anyways. So on that Google Scholar, some things that are worth digging into is how to perform research, um, multiple time frame analysis is another good one to research on there. Correlated market is another one because a lot of times that's what we're doing, right? We're looking at, say, the Nasdaq and the S&P. That's two markets. We're trying to understand what price is doing, or we're looking at oil and gold, or gold and treasuries. It Price is always coming from another direction, right? Another product. We're always trying to get answers. So correlated markets is a big deal. Being able to better understand that, and I would bet they've got some papers on it. If this is right and we get a bounce here in this, I think we're going to get a pullback in the S&P and in the Nasdaq, but especially in the Nasdaq because the Nasdaq is at resistance right now. Well, remember, potential resistance. We're at potential resistance right there. And if this is overextended and starts to come back to the upside, that's going to send the Nasdaq down. Not into some big massive sell-off like we had at the front of the year, just another pullback like 2.5, 3%. Short-term trade, 2 or 3 days, maybe a week. But you never want to short all-time highs, and you never want to buy all-time lows. So as long as we're still going up, I wouldn't mind putting the trade on in options, right? What we're talking about here. The options trade, if we're still going up, the options trade is the good play. But if we already started to reject and to fall down, I wouldn't want to buy puts after we're already falling. We might shop around Friday because we've got OPEX next Friday. So we could start shopping around for some cheap lottos. If they hit, they'll pay out really nice, but they're going to have a low win rate probability, which also means they're going to be really cheap. They're not going to be high conviction trades. And then on Friday, there was a request that came in too late today to do it, but a question about stock and options and getting in on swing trades. This is always a good topic. They always talk about these hypothetical perfect spots like the previous high, the previous low. And here's two really good examples right here where we never actually reached that low, or we overshoot the high and we've already fallen back in too, right? It's never like the books make it sound, that we're supposed to get these fantastic entries off of quote support and resistance, and it's unrealistic. So there's um, there's no perfect way to get around it, but uh, yeah, everybody's got to put their own approach together. We'll go over the way I do these, and it ties in with what we've already talked about with options about the verticals that I use at the money instead of out of the money. That way we get a fair price if you're selling them. And how to trade these if you've got a day job where you missed the first part of the day, because that's not really a big deal. I know people think it's a hang up, like, oh, I couldn't trade at the open. It's a swing trade. You don't need to trade at the open. In fact, you're better off not trying to put an options trade on between 9:30 and 10. That's a really bad time to put options trades on. You can get them in the later part of the day, and you can get them from the daily chart. You don't even need to go into the intraday at all. If you do, it doesn't hurt anything, but you got all the information you need on the daily to take swing trades. And usually, 4 or 5 weeks is all you need showing, right? Like, it's not always going to be your answer, but that's about what I've got here. 40 days. 40 days is good. You can see what's going on. You got a nice uh, visual. You're not squinting at the candles. It's all zoomed out, and it's not too close, to where you can't see anything. So we're going to talk about swing trade entry tactics Friday, and anything else you guys want to dig into. I'm open. Might as well add the trade checklist to this. When it comes to options, having a checklist really saved me a lot of work, because there's a lot of things you need to kind of validate before you get in. Silly things like, does this market have options? Does it have earnings in the next 4 weeks? Or is there a dividend in the next 4 weeks? That's a really important question. But when I was new, I would forget to check that stuff, right? Then I would go to get into a trade, burn a PDT, because then I'd realize after I got in, oh shoot, it's got dividends next week. Nah, I need to get out. All right, and then you get back out, you burn a PDT. That was a waste. So the checklist can help you filter those kind of mistakes out, and you don't make them. And then it can help with the fear and the greed, because you've got a set of rules in place for, okay, the trade's winning. Where should I take profit? Well, what does the rules say? Or it's losing. What should I do about it? What does the rules say? It doesn't mean we're going to follow the rules all the time. That would be nice, but I mean, most of us don't. But at least it's written. You know what you're supposed to do. Whether you actually do it or not, it'll be completely different. So we'll get into that Friday, and anything else you guys want to cover. You just hit me up. We'll put something together on it. It doesn't have to be swing trade stuff. I just tend to focus on that more because everybody else is already talking about day trades and futures, and we try to represent a little bit of everything. And if they're going to cover futures all the time, then I want to cover something else. But we can talk about futures. I don't care. We can talk about anything really. Yeah. Uh Reach out to me, send me a DM, and I'll tell you, 5 years ago or before AI, if I had to spend hours building somebody's indicator, I would bill you for it. But most of the stuff that people ask for, they're not hour-long indicators, you know what I mean? They're like 2-minute indicators, and I'm not gonna bill anybody for that. Plus, now we have AI, so it doesn't even if it's massive work, AI does all the work. I'm not gonna bill for that either. So unless it's something that I've gotta take time away from my family and spend a couple hours in the office, I'm not gonna bill you for anything. Just reach out to me. If I don't already have it, I'll probably know where to get it, or I'll know how to get AI to get it, or I'll know we can't have it, right? Because there's just some stuff that we can't get. Yeah, you can do it in the question section, or you can just send me a DM, right? Like you could just click on my name and send me a message. I just sent you a friend request. So if you check your friend requests, then you can send me a direct message. But you can use the questions tab too. There's no secrecy, right? It's just an indicator. Whatever is comfortable for you. But I always want to try to help people so that they don't go spend crazy money for an indicator, especially if it's something that is so generic like a tool to mark yesterday's high. And there's places that are literally selling that indicator, a thinkorswim indicator that marks yesterday's high, and they'll charge you $10 for it. I know it's only $10, but it's the principle of the thing. Why would they do that? That's just, it's not cool, you know. Hey, it's America. I get it. Entrepreneurs and all that live the American dream, create a small business, but to me that's just taking advantage of people. It's a lot easier to make indicators now because of AI. When I started, I was just poking around on Thinkorswim, and I would copy and paste from different indicators, and that's where I started out. It worked. It wasn't fun, but I got there. So take the time to put your thoughts together and really articulate what it is that you're trying to do, and then I will read it and see what we can come up with. I'm gonna hop off of here for now, go get dinner started, but I will be back tomorrow as usual for the morning briefing, and I'll read whatever you send me at that point. A good daily open. There's one on Thinkorswim. Um, when you go into the beaker, just type in the word daily, and you'll see all of their daily indicators. And they've got one called Daily Open. Now, when it comes to futures, if I remember right, that thing's a little wonky, and it wants to do like the 6 p.m. open, if I remember right. Can't remember. I remember having an issue with it. Let's see what it did. Yeah, it marked the open from 6 p.m. Right. So I ended up having to code this with Grok. Hmm. I'll get that market open. I will get that because I already had it. I think the last time I cleaned out my Thinkorswim, I must have threw it out, but I will get it back again. Oh yeah, the market open is a really powerful pivot that a lot of people don't even pay attention to. It's really valuable. The thing is, I almost always mark it by hand because I don't on my charts. What you guys don't see is that my charts are naked, no indicators whatsoever. And when I send pictures in the chat, it's uh, it's always got drawings and stuff on it. So there is a one for toss, but it doesn't work on futures, right? It goes to 6:30 or 6 o'clock open, and that's not what you want, right? You want the 9:30 open. See, if I go to daily for toss, daily open, and I look at it on the futures, it's not marking 9:30 open. It's marking the 6 p.m. open from the previous night. Yeah, no worries, Rob. I'm gonna either find mine that I've already developed before, or we'll develop another one because we need to have that one, which is why I had it. I've already done this, but I just can't find it. So one way or the other, we'll get that one done. Yep. Everybody, have a good night. We'll see y'all at the morning briefing.